Hi everyone, I'm Kevin Hanegan and welcome back to Know Your Data. In this episode, I'm joined by John Webb from Experian. Welcome, John.
Hi Kevin, great to join you.
Today, we're looking at credit scores. I know what they are, I know they can affect our loans and our interest rates, but I don't know how they're calculated and what makes them up. So, what data should we be aware of?
Thanks, Kevin. So this is a really good time to distinguish between the credit score and the credit report. So the credit score is based on all the data that's in your credit report. And your credit score is calculated using scoring models. Now, effectively, what this does is uses the past to predict the future. Your credit report contains your borrowing history over the past 6 years or so. A score will take that and give you a numerical expression of how well you're going to repay credit and manage your credit in the future. The easiest way to think of this is, have you repaid well in the past? And if you have, you're more likely to repay well in the future. So it kind of tells the story to a lender of your credit risk.
So one of the things you mentioned, which was really interesting, was the story. And as it relates to data analytics, storytelling with data is really important so people can understand what that data is and what it means. What this brings up to me is, how often is the story of your credit score being told?
Typically, we know that when you apply for credit products like a loan or a credit card or a mortgage, we generally think someone will be checking our credit report. But it's also used for things like getting a cell phone contract, home broadband or TV services, insurance, ID checks, but finally, background checks. So when you apply for a job or even renting a property, it can be used. So you kind of see the breadth of how often and for how many services your data can be used.
That's really fascinating. I had no idea what the background checks or ID cards are similar. What data should we think about as we're trying to improve our credit score?
So the primary way to build your credit score is building a track record of borrowing. Lots of people think if I don't borrow, that's going to put me in a more positive situation. Actually, lenders have no way to judge you and they have no way to judge your risk. So this is where over time, which is usually more than a year or so, trying to build a good track record of borrowing, but importantly, repaying on time. That's the crucial bit, because lenders are going to be looking for, have you repaid on time and repaid your credit agreement successfully? And if you have, they're far more likely to lend in the future and you're more likely to get the best rates.
Really good point. I personally would like to know, what are things that I should avoid?
We know that your data that sits on your credit report and what calculates into that credit score determines whether or not a lender will lend, but also the rate that they can lend at and how much they're going to lend. So it can be expensive if you've got any blips or anything on your credit report that could be dragging your score down. Some of those things could be that you've opened lots of new accounts in a very short space of time. This really reflects how credit scoring works, because if you're in that scenario, there's no data to view. There's no data to judge how well you're going to or have repaid those accounts in the past. So lenders are going to be looking at that with a little bit more risk. The other thing is your credit cards factor in quite heavily in your credit score, particularly where you're very close to the limit. Quickly signifies to lenders that maybe you're a bit too reliant on credit rather than savings or money that you're getting into your current account, for example. The next one is very high debt. So of course, lenders don't like to see very, very high levels of debt. Now that can be a particular worry where maybe your overall debt exceeds your annual salary, or just where it becomes unaffordable. So you can't afford to keep the repayments on your existing credit. And the final point here, by the way, is missing any payments. So what underpins credit scoring is, of course, looking at the past to predict the future. And the really important part is making your payments on time. So if you start missing payments, lenders will think that you're more likely to miss them in the future.
Absolutely. I mean, that's a great takeaway for everyone is always check your data, right? The data doesn't lie, but it might be missing things. And it's important to understand those as we drive forward. So great. As we end this episode, let's take a look at the key takeaways that we learned from John. So even when we don't realize it, we're creating financial data every time we spend money. All of this data is being used to create scoring models to identify if someone like a bank will loan you money and whether you will reliably pay it back or not. For us as consumers, we need to understand what data they're looking at so we don't fall into these pitfalls. John, thanks for joining us today. And as always, let us know if there are any topics you'd like us to cover in future episodes of Know Your Data.